You know what drives me absolutely crazy? Watching people throw money at the stock market like they're feeding coins into a slot machine, completely ignoring the fact that they've got credit card debt charging them 22% interest sitting right there laughing at them. It's like trying to fill a bucket that has massive holes in the bottom and wondering why you're not making any progress. Spoiler alert, you are mathematically destroying your own wealth. Today, we are going to fix that. People ask me every single day if they should buy individual stocks, or what ETF is going to pop next, or if they should put their paycheck into crypto. Meanwhile, they carry a balance on their Visa card. It's like trying to fill a bucket that has massive holes in the bottom and wondering why you're not making any progress. It is mathematically backwards. You are building a house on quicksand and hoping the paint job will keep it from sinking. My name is Nick, and I spend way too much time thinking about money, optimal investment strategies, and why most people seem determined to do everything in the exact wrong order when it comes to building wealth. If you're someone who actually wants to understand the proper sequence for investing your money, make sure to hit that subscribe button. Today, I'm going to walk you through the exact, optimal order you should be investing your money, step by step. We are going to cover why your employer match comes before almost everything else, and why a boring health savings account might actually be the most powerful investment vehicle in America. Before you invest a single dollar in the stock market, you have to build the bedrock. According to recent data, 1 in 3 Americans doesn't even have an emergency fund. The median amount Americans have saved for emergencies is a whopping $500. That's less than a modern car payment. An emergency fund isn't just about paying for a broken water heater, it's a psychological safety net. Recent research from Vanguard found that people with just $2,000 in emergency savings had financial well-being scores that were 21% higher than those without. $2,000 isn't life-changing money, but the psychological impact of having that buffer is enormous. Get to $2,000 immediately, then build it to 3 months of living expenses. Once that cash buffer is in place, you face the ultimate wealth killer, high-interest debt. I'm talking about anything charging you more than 8% annually. Credit card debt is the obvious villain here. With average interest rates hovering over 22%, credit card debt is financial cancer. It grows faster than almost any reasonable investment return you could ever expect from the stock market. Every dollar you use to pay down a 22% credit card is essentially earning you a guaranteed 22% return on your money. Warren Buffett is considered the greatest investor of all time, and his long-term average is around 20%. You can beat Warren Buffett's returns right now, today, just by paying off your Visa bill. Stop buying stocks. Kill the debt first. Now, there is exactly one major exception to the rule about paying off debt before investing, and it is so important that it becomes the next step in our sequence. If your employer offers matching contributions to your retirement plan, you must contribute enough to get the full match, even before you finish paying off your debt. This might sound counterintuitive, but the math is undeniable. Employer matching is essentially a guaranteed 100% return on your investment up to the match limit. Let's say your employer matches 100% of your contributions up to 5% of your salary. If you put in $3,000, they hand you another $3,000? No other investment opportunity on earth can guarantee a 100% immediate return. It is literally free money lying on the ground. Even if you are carrying credit card debt, capturing a 100% return outpaces the 22% interest penalty. Take the free money, capture the full match, and then aggressively redirect all your remaining cash flow back to destroying your high-interest debt. Once the high-interest debt is gone and you are capturing your employer match, we enter the tax optimization zone. This is where most people get distracted by shiny objects. Instead of maximizing tax-advantaged accounts, they open a Robinhood account and start day trading. That is a massive mistake. Your next step is to maximize your individual retirement account, or IRA. Why an IRA before putting more money into your employer's 401k? Because your IRA gives you absolute control. Corporate 401k plans are notorious for offering a limited menu of terrible, expensive mutual funds with management fees that eat into your returns like termites in a wooden house. With an IRA, you can invest in low-cost index funds that charge practically nothing. Over 30 years, a 1% difference in fees can literally cost you tens of thousands of dollars. When opening this IRA, you have to answer the ultimate tax question: traditional or Roth? Do you want to pay taxes now or later? A traditional IRA gives you a tax deduction today, but you pay taxes when you pull the money out in retirement. A Roth IRA forces you to pay taxes on the money today, but it grows completely tax-free, and you pay zero taxes when you withdraw it. The general rule is simple: if you are young and in a lower tax bracket now than you expect to be in the future, choose Roth. Pay the cheap taxes today, and let the compound growth be entirely yours. If you happen to have access to a high-deductible health plan, this is where we unlock what might be the single most underutilized investment vehicle in America, the Health Savings Account, or HSA. Most people think an HSA is just a debit card for buying aspirin or paying copays. They are entirely wrong. An HSA is the Swiss Army knife of investing. It is the only account in the entire U.S. tax code that offers a triple tax advantage. First, you get a tax deduction when you put the money in. Second, the money grows tax-free while it's invested. Third, and this is the kicker, withdrawals are completely tax-free as long as they are used for qualified medical expenses. But here is the ultimate wealth strategy: do not spend the HSA money. Pay for your current medical expenses out of pocket if you can, and let your HSA money stay invested in the stock market. Keep all your medical receipts in a folder. There is no time limit on when you can reimburse yourself. You can pay for a doctor's visit today, let your HSA compound for 20 years, and then reimburse yourself tax-free 2 decades from now. If you max out your HSA for 30 years and get a 7% return, you could easily build over $400,000 in completely tax-free money. Since medical expenses in retirement are essentially guaranteed, an HSA is a secret weapon against the biggest financial risk of your older years. Once you have maxed out your IRA, maxed out your HSA, and gone back to max out the rest of your employer's 401k limit, then, and only then, do we finally reach the step everyone wants to start with: taxable investment accounts. This is the Wild West. No contribution limits, no withdrawal penalties, total flexibility. But there is a reason this is the absolute last step in the optimal order. It's called tax drag. Every time a company pays a dividend, you get taxed. Every time you sell a stock to rebalance your portfolio, you get taxed. It is like running a marathon while someone keeps throwing sand in your shoes. You can still finish the race, but it is going to be a lot harder. The tax efficiency of keeping money in retirement accounts versus taxable accounts is staggering. If you invest $10,000 annually for 30 years in a tax-advantaged account earning 7%, you end up with about $944,000. In a taxable account with the exact same return, after paying taxes on dividends and capital gains along the way, you might end up with closer to $700,000. That is nearly $250,000 vanishing into thin air simply because you didn't use the right account. So, there is your blueprint. The optimal order for investing your money that most people completely ignore in their rush to get rich quick. First, build the emergency fund. Second, destroy the high-interest debt. Third, capture the employer match. Fourth, maximize the IRA. Fifth, weaponize the HSA. Sixth, max out the 401k. And finally, pour everything else into taxable accounts. Follow this exact sequence, and you will be building a financial fortress while everyone else is still trying to guess which meme stock is going to pop next. Stop playing the lottery with your future. Secure the foundation, optimize your taxes, and do the boring stuff first. Trust me, your future self will thank you for it.